chapter 7. Still loading. Yeah, so where we were at. I think we were talking about notes, getting into notes with me. All right, guys? So, all right, so they're in writing, sure. And they're a negotiable instrument. What does that mean? You can sell them to somebody else, right? Not that you couldn't do your receivables too, but these are negotiable instruments. Okay, maker signs in favor of the payee. Of course, they're interest bearing, has a stated rate of interest typically, or they're zero interest bearing, but there's no such thing as zero interest, right? So we're going to have to discount a zero interest bearing note. Or if it has nominal interest, let's say the market rate is 10% and the note only has stated rate of 2%, we'd still compute what the market rate is, right? Just makes the accounting a little more complicated. We always record interest revenue or interest expense on every security, not just notes, but certainly on notes, right, receivable or payable. We're going to record them at market. Okay? This is where I'm doing business with the related party. It might be that it's a parent company loaning money to a subsidiary or vice versa. It might be relatives, officers, got the idea of major shareholders, that sort of thing. Okay? And it might be a vendor, right? Loans your money, interest free. Well, what do they do then? They charge you more for the product to cover the interest. It might be a customer who loans you money interest free. You sell for a lower price to them. So we always adjust that. We always adjust the market, okay? That is typically with related parties. All right, anyway, so that's the deal. So let's take a look at it. Okay, so it could be customers who need to extend a payment period on a receivable. So our debit accounts receivable credit sales when I sell it. Now they reach the due date and they can't afford to pay me. What do I often do? Sign a note. Because now if we go to court over it, they can't say you didn't deliver the product or the product was faulty. They agreed they owed it to you when they signed the note, right? So and maybe you'll collect interest. Usually we don't care if we get the interest, we just want to get paid the receivable, no, right? But we might get interest on it too, okay? And, or maybe the interest becomes a bad debt too, so then maybe we wouldn't even record the interest revenue during the term that we're holding the note until they actually pay it to me to be conservative. But anyway, yeah, so what would that entry be, by the way? I no longer have the account receivable. Credited. I now have a note receivable. Debited. Big deal, right? So you can make that entry, of course. High risk or new customers. I have a new customer and I don't know their credit history. I haven't signed a note, right? Don't trust them on open account. Or they're just high risk in general. Somebody who didn't pay me before me. Loans to employees and subsidiaries. Sales of property, plant, and equipment. I sell it and I do it with a note instead of an open account receivable. That'd be fine. I'm going to get payments, right? And I want interest. Okay, I'm waiting for a while, maybe. And then the lending transaction is the majority of notes, right? I loan somebody money. So I credit cash, give it to them, and debit note receivable. Got it? Just the other side is note payable, of course. They debit the cash, credit note payable. Same terms and everything. I have interest revenue, they have an interest expense. You guys already know how to do a lot of this stuff, of course. All right, so how do we record it? Short term is just like an account receivable. Face value less the allowance. Got it? That makes sense, doesn't it? Okay? Why? Very short term. Yeah, liquid, not much time going to go by, right? We don't have the time value of money to consider. We consider it material. Long term, recorded the present value of cash expected to be collected. Okay? That would be the interest and the principal, the present value of that. Because if it's a nominal interest rate, right, that's not enough interest. So we take the current value of both. So you might have the present value of the face amount of the note, right? And then you might have the present value of the interest stream, which is like an annuity. It's just like valuing a bond. You already know how to do this. okay? All right, so the note, if the note is issued at face value, okay, premium discount, of course, okay, medium. All right, so then they give us an example. They're doing the principal plus the interest. This one is let's skip this one because it's showing, it's ridiculous. They said the market rate is 10%, and then they discount the interest at 10%, and the face at 10%. What are you going to come up with? If the market rate on the note, just like a bond, when you're doing bonds payable, investment bonds, if the market rate on the bond is 10%, and you discount it, the effective rate, or yield rate is 10%, what are you going to calculate?
Just the interest on the bond.
Yeah. But the cash flow is actually 10% of the face, right? And then you're going to discount that interest at 10%. And you're going to discount the face at 10%. And you're going to add the two together. What are you going to get? The face value. You're just going to come back to face again, right? So why would anybody do this calculation? Okay, I don't know, but they did it. I get it. Yes, they did it just to show you that's what happens. So there's the value of the interest. There's the value of the note, and when they add the two together, it's 10,000. You see it there, you guys? Okay, and then they just do the journal entries. Fine. Well, that's the course. Okay, let's do a little different one. This one is a zero interest-bearing note. The market rate of interest is a note similar is 9%. Okay, and it's zero interest-bearing. So what are you going to do? Take 9% as the interest. So we'll take the present value of the $10,000. There is no interest stream, right? So we take the present value of that. So they're looking up 9%, right? Present value of the principal, there is no interest, and they calculate it. So the bond is worth $10,000, I'm sorry, note is worth $7,722, and it's a $10,000 face value note. What's the difference between the two? Interest at 9%. That's it. Okay? What are we going to record for a note receivable? This, $7,700. Or you can record a note receivable of $10,000 less a discount, which would be a contra asset account, right? Less a discount for the difference, $2,300. Got the idea? Either way, we're either going to amortize. We're going to amortize by increasing from $7,700 in the note up to $10,000 by the time it's paid off at the end, right? Recognizing interest revenue, okay? Or we can amortize the discount if we have the discount. And it has exactly the same impact, right? Exactly the same effect, okay? So here we go. Here's your little amortization table. Notice the date at issue. Carrying value of the note is $7,700. And when we say carrying value, that might be the amount that's in note receivable, right? Or it might be that the note receivable has $10,000 in it, and then you have a discount of $2,300. Either way, that's a carrying value, right? Okay, and how would you unwrap the deal? Well, 9% of that $7,721.80 is going to be the interest expense for the first year. You guys with me? For the first period. So 9% of it is $694.96, huh? Interest revenue. And what would you do? Debit the note receivable or debit the discount, either one, right? Increasing the carrying value of the note, so it goes up, right? So we debit the note, effectively, right? Increasing it, and credit what? Interest revenue. So I'm recognizing the interest revenue across the term of it using the effective interest method. That's all we're doing here. Everybody got it? Remember that from doing bonds? Okay? Principles. So then the next period, of course, we have a higher carrying value of the note. So it's 9% of that, right? Because effectively they borrow the interest from us, haven't they? Here's how much the note was. Borrowed interest. You get the idea, guys? Okay, it goes up. 9% of that is the next one. Okay, same deal. Debit the note, right? Or debit the discount, either one, reducing it, and credit interest revenue, and it just builds. And so why do we come up to the $10,000 at the end? Because this one's only a 3-year note, huh? That's it. So each year I have this much revenue recognized, $695, $758, and $826. Got the idea? So I get the total $2,300 of interest recognized as revenue, and I get my carrying value of the note up to $10,000, and then they pay me the $10,000, right? Debit cash and credit notes receivable. Everybody good? And if you use the discount account, the discount just goes away, right? You tend to have already been in there, right, in that account. And the discount would have just gone away, been amortized out. Okay, so here's the entry to show the receipt of the note. All right? Debit notes receivable, credit discount, they're using the discount approach. If you wanted, you could just make notes receivable be the 7,700. I've said that enough times. Everybody's got this. It's not a big deal. And credit cash. Everybody got it? Easy. Revenue at the end of the first year, debit the discount, credit interest revenue. It goes away. Everybody good? And then we do the same thing the next year and the next year. The discount's gone after 3 times. Okay, now this gets a little more complicated, just a little. Now I've got a $10,000 note that pays 10% interest, but the market rate's 12. And we think that difference is material, or we wouldn't bother with this, right? Okay, we think that difference is material. Okay, I prefer an example maybe where the stated rate is 5 and the market is 12, so it's a bigger number. But it's okay, right? It makes the point. So what do I want to do? I want to figure out the present value of 10,000 received 3 years from now, right? And I want to figure out the present value of 10%, which is 1,000 a year, 10,000, right? Received at the end of each year. Everybody got it? And then I'm going to add those two together, and that's what the note is. And then I'm going to have effective interest of 12%. Okay? So let's see how this thing works. Yeah, okay, there's 12%. Okay, so there's the 1,000. There's the interest, annuity factor, right? Present value for, was it still 3 periods? Okay, at 12%. So that $3,000 of interest is worth $2,402. Everybody knows how to do this. See, we're doing the present value today. Fast. Okay, so then the principal, 10,000 times 71 cents, right? Because I'm getting it 3 years from now. So I've got the principal plus the interest. That's 7,118. Everybody good? I discounted at 12%. Okay, so they add the two together. Again, just like we were doing a bond or something, right? The face is 10,000. The present value of the principal we said was 7,118. Present value of the interest is 2,402. The amount we're going to get paid is 9,520. So we're short by 480. So this time the discount is 480. That represents the 2%. Everybody agree? 10% is the stated rate. Effective is 12. Are you guys staying with me on this? I'm moving quick, but it's pretty straightforward now. And it's things you're kind of familiar with, isn't it? Right? See, the benefit of getting things down really, really well is you can learn really, really fast. When you're at work, you have these kind of almost cryptic conversations with people. I don't understand this. And they just go straight to it. They won't tell you the background of it. They won't tell you the theory of it. They won't tell you what, what the history was. Are you with me on this? They'll be, okay, you know this and this and this and this, right? But go real quick. And like I just did with you guys. And they'll sort of get you on the same page, or you're on the same page, and then they'll dive right in and just explain the pieces you're missing. And you'll ask very pinpointed questions like, whoa, I understand all that stuff. I don't understand this. I don't get that. I don't get that. Okay? That's what I'm trying to do with you guys. We don't have very much time, right? You never do. You're never going to have enough time. There's unlimited to get down, right? I can teach you guys all sorts of things that you could just go faster. Is that true? We're trying to turn you guys into CPAs with basically 2 years of coursework. Spread about 4 years, but 2 years of coursework, basically. Right? Really. We're going, right? We're just digging in, going after it. Could we take 8 instead? Sure, it'd be much more comfortable, wouldn't it? So you want to give me another 4 years? And not work for those 4 years? That's an attorney. No, it's only 2 years. You go to school for 4 years, and they go to law school for 3 years. To make the same starting salary you guys are going to have after 4. I don't get it. Right? My son didn't either. He became an attorney. It's kind of geez, I love being a lawyer, but law school was ridiculous. Yeah. So, what do we do with this in journal entry wise? Can you envision the journal entry? What's it going to look like? Notes receivable, discount, cash. By the way, what if I was selling something to somebody? Selling a product. What if I was selling product? What would it be credit instead of cash? Sales. That would be the sales price. Right? And then I debit cost of goods sold and credit inventory at the cost of it. Recorded my sale. If I sell on a note long term, guess what? My sales price is less. because there's going to be interest revenue. Right, guys? That making sense? Whether it's zero interest or nominal rate of interest, or lower, less than market rate of interest like this, right? Same case, okay? We do that. So, no big deal. Good. So, what's my interest rate going to be? 12%. So I'm going to do an amortization table with that. Okay, here it is, 9520. Now look what happens. I'm getting $1,000 cash coming in each year, right? But I compute my interest revenue, 9520 times what here? 12%, right? So there's the 10% cash flow based on the face amount. There's my interest revenue based on the actual carrying value of the bond, or I keep saying bond, of the note, right? And the difference between these two is what? 142. What's that? More interest revenue than I received cash. Give me the journal entry for this thing. What's it going to be? Cash received. What do you think? How about debit cash? What's this going to be credit to? It's the interest I earned. Interest revenue. What's that going to then be a debit to? The discount's going away. Discount notes receivable. Got it? Or if you recorded the note at its net amount, it'd be just debit the note, bringing the value of the note up. And we've only got to amortize the $480, right? Because that's all the discount was, the difference between 10% and 12. Okay? So guys can handle this? So each one of those journal entries, they'll show you the entry here. Nice. Debit cash. Debit discount and notes receivable. Credit interest rate. Boom. Do it 4 times. What do we have left in the discount? Nothing, right? And at the end, they owe us $10,000. They give it to us. What? Debit cash 10,000. Credit the note receivable 10,000. Deal's done. Okay. By the way, how about if I were selling, instead of selling product, I'm selling a piece of equipment to somebody and they give me a note for it? What would you do? Debit the notes receivable, credit the discount, or just make the note receivable for the net, right? Credit equipment for the amount we originally paid for the equipment. Debit accumulated depreciation for the accumulated depreciation up to the date when we got rid of it, right? Huh. And then we wouldn't have cash paid out of credit, would we? What would we have? We gave up the equipment. We have a note receivable. So the credit equipment, debit accumulated depreciation. What's the difference between the value of the note, right? Discounted present value of the note, and the book value of the equipment? Gain or loss of sale. Boom, we're there. So it could be a gain or loss on a sale of a piece of equipment or a building or something, right? Any asset. Or it could be a sale, or it could be a loan. It doesn't matter. We calculate the value of the note the same, no matter what. The interest portion is going to be the same no matter what, right? Everybody got it? Okay, not that. And you know what? If you can do this side, you can do the payable side, can't you? Just the mirror image of it. So once you get it down, you got it made, right? Only obviously on the payable side, I'd be buying the piece of equipment, right? But I'd value the note the same way. And then it'd be the cost of my equipment, right? Or I'd be purchasing inventory, so it'd be the cost of my inventory. I determine it using present values, just like this, right? And I have a note payable, right? Instead of a note receivable. Everybody good? If I was borrowing money, I'd debit cash, right? Credit notes payable. And I still have the discount to mess with. By the way, can you have a premium? Theoretically, you could, but in non-arm's length transactions, you cannot. You know, you can charge a higher, you can charge the same or less. Okay, cool. You guys look thrilled. I hope that means you really understand everything I'm saying. I'm boring you to tears because you already know it. Right? Good. All right. Notes received for property, goods, or services, I just said that, right? Bargain transaction entered at arm's length, the stated interest rate is presumed to be fair unless there's no interest rate or it seems unreasonable. Face of the amount of the note is materially different from the current cash sales price. If I could have bought it for a lot less than the note, there's interest. Come on. I love it when they sell furniture, 1 year interest free. There's interest free car loans, right? Is there still interest? Of course there's interest. They added to the sales price. Sometime in a furniture store saying interest free for a year ago, and I asked them how much they want for it, you just have it cash. real money. And suddenly the price goes down. What does it go down by? The interest. Yeah, the interest. You bet it does. They're not gonna let you walk out the door. No way. They have to borrow money. They have their cost of capital. They at least have their weighted average cost of capital covered, right? Yeah, sure. So fantastic. And then they do an example fine. They calculated the fair value of the property. Okay, this is the same thing, isn't it, guys? Right? This is kind of interesting, though. Look how big this example is. Look how big the note receivable is and how inexpensive the land was that they bought. What is it mostly? Because it's a long term. 5-year, right? What's the deal? No stated interest. Originally cost $14,000. Market value of 20, right? So what's the deal? So what do we think the land had a historical cost of 14, right? So what do we think? If it has a fair value of 20, we could maybe sell it for 20. I don't know if they quite did this right. Does somebody not like this? The land originally cost 14. We think it has a fair value of 20. We use that as the present value of the note. Yeah, that's okay. The note is 20 that we got, right? And the land is 14 that we gave up. What I don't like about it is their journal entry doesn't balance. There's one more line?
Yeah. Every game.
It's got to be a gain, right? Where's the gain? Oh, they didn't put it in. Okay. Sorry. Where is it? Yeah, something's wrong. Okay, yeah, you got to have the gain. So the difference between the 20 and the 14 is the gain, of course, right? But we get the note recorded at the value of the note. If we believe the fair value of the land, okay? So, by the way, in these sorts of transactions, do we sometimes not really know what we sold something for? Because we don't really know what the interest rate is? What if we knew what the interest rate should have been? What would we have done here? And you don't know the fair value of the land. We're going to record whichever one we know better, right? If I know the fair value of the land's 20,000, then I can figure out what the interest rate is. We can figure out what the discount rate must be here, huh? You guys agree with that? We can figure out what the interest rate is, so that 35,247 is 20,000 present value. So we set the present value to 20, and this is the value of the note, right? The note receivable, so maturity value, and then we can figure out what that discount rate must have been over the 5 years, okay? We could get the interest rate based on the fair value. What if we don't know the fair value of the land? What could we do? But we do know the interest rate. We could discount this 35,427 at the interest rate and come up with what the present value of the note is, which must be the fair value of the land. So you can go either approach. And what we do is we take the one that is most readily determinable, wherever we can get a better estimate. Okay? Either use the interest rate or the market value, whichever one is more readily determinable. Okay? And we'll do that a lot as we go through property, plant, equipment, stuff like that. Okay, good. All right. Valuation of notes receivable, short-term net realizable value. We said that, didn't we? Long-term FASB requires companies disclose not only their cost, but their fair value of the notes in the financial statements. So we already did that. Okay. Fair value option. This was kind of cool. You have the option to use fair value as the basis of measurement in the financial statements, but be careful, right? Once you choose to either use fair value or not for a particular note, what are you going to do? Keep using it. You have to be consistent. You can't switch. Okay? Everybody got the idea? So receivables are recorded at their fair value then, which should be what? Discounted present value. Okay? Unrealized holding gains or losses are reported as part of net income. What? The fair value of them change period to period, right? What we've been doing so far is you record it, right, at the date of the transaction, and then you amortize the discount or premium over the life of the particular security, right? Notes in this case. Right, guys? What would you do if you use fair value? You figure the fair value at the end of each accounting period, and record a gain or loss, which hits your income statement. Everybody got it? So the unrealized holding gains or losses are reported as part of net income. This is very similar to what we do with available for sale securities, isn't it? Okay? Same sort of idea. Company reports the receivable at fair value each reporting date. Okay, that's just fine. Okay, companies may elect at the time the financial instrument is originally recognized, when you record it in the first place, when you purchase it, right? Okay, or get the note. When some events trigger a new basis for account, okay? Must continue to use fair value measurement for the specific instrument until the company no longer owns it. If you did not elect it at the date of recognition, the company may never use fair value. So you've got to go one way or the other. But here's the rub on this. Some companies will use fair value, some won't. Will they be comparable? Maybe not, okay? So that's a little bit of a problem. Also, even within a company, can they choose to use fair value on some and not on others? Yeah, and it can be on everything. Might you use fair value on the ones that gain in value the first time you evaluate and not use it if they lost in value? Yeah, but then you're stuck. You're still stuck. If it recovers in value or it goes down in value, one way or the other, you're still stuck with whatever you selected. So, okay, cool. So they give you the fair value option here. Unrealized holding gain or loss. It changed by 190,000 during the period, and they have a gain. Lovely. All right. So now, what do we do? When you're running a business, lots of times you like to have, or you need to have, more cash than you got. Okay. What are the ways you can get cash? Sell product, cash, get cash. I love that. But what if I need to grant credit in order to get more sales, right? Or to get sales at all? So I draw credit, sell an account, right? That's not cash. What if I need the cash soon? I can go borrow money. But if I borrow money with no collateral, right, the interest rate will be higher. That makes sense? And at some point, people won't even loan me money, depending on my riskiness, how much debt I have compared to my equity, right, guys? So what do? I mean, my receivables is collateral. Like in my inventory is collateral, right? When you buy land, building, and equipment, by the way, you give them the land, building, and equipment as collateral, right? Mortgages on the land and building, right? Liens against equipment, right? Machinery, right? And then you wrap it up in the debt. Otherwise, you have a much higher interest rate, or maybe you couldn't even borrow, okay? So typically what happens is long-term debt finances non-current assets. Does that make sense? Property, plant, equipment, right? Current debt, you'll have an operating line, working capital line, right? An operating line that is supposed to finance your cash on hand, your accounts receivable, your inventory. What happens if that's not enough? Now what you might do is you might use your inventory and your receivables as collateral, right, for additional debt. Although you might have tied it up in your operating line already in a lot of companies, right? They already have that lien against that, right? That's already collateral. But if it's not, let's say your receivables are not, what you could do is you could assign them as collateral for loans. Now what happens with an assignment? I mentioned this last time real quickly. What happens with an assignment? I have given them those particular receivables. I haven't sold them to them. But yeah, it's assigned to them, right? So if you loan me money, right, when I collect those receivables, I must give you that cash. Make sense? That's all it is. They're assigned to you. So I can't use the cash for whatever I want to use it for. That's an assignment. Okay, it's still collateral, but it's specifically assigned. Or if you don't trust me to collect it, you could collect the money. Keep the portion that you had loaned me, right? And then send any additional to me. Right? Does that make sense? And so usually when we assign, I'll assign you 800,000 of receivables, but you only paid me 600,000. The extra 2 is your cushion, your safety, right? So the first 600 I collected that I have to give to you plus the interest. That making sense, guys? Okay. Now that's assignment. Factoring is different. Factoring is when I actually sell my receivables to somebody. They take title of my receivables. They're theirs. They can resell them to somebody else. They can use them as collateral for a loan themselves. Got the idea? I exchange title to them to somebody. They're going to collect them, right? And I'm out of the deal, right? I sold them. When I sell something, I have a gain or a loss. Loss in this case, right? I have a loss. It's not borrowing, but it's a way to get cash out of my receivables. So fundamentally, it's a different transaction. Does that make sense? These are sales. Factoring is sales. Assignment is borrowing money. Everybody got it? Okay? So, by the way, if I'm more risky, what happens? The more risky I am, the more collateral I have to give. The less secure I am, maybe I have to actually factor, right? So they take total control. I don't have enough anymore. This is an extremely expensive way to get cash. Okay? Assignment is more expensive than just using your receivables as collateral, right? Because they're going to charge you a fee, and then they're going to charge you interest too, right? Fee for setting up and interest. On factoring, they're going to charge you a whole bunch, right? It's not interest, but you're going to have a big loss. So, okay? So people who are really strapped for cash do this, okay? Keeps them floating for a while, keeps them in business, all right? And then some industries are kind of just set up with factoring arrangements, okay? All right. So people who are undercapitalized don't have a lot of cash. So, anyway, so ways you could do it. Selling receivables because money's tight, building and collection are time-consuming and costly. Okay, so we can either use secured borrowing or sale of receivables. So we got both. Oh, by the way, on factoring it can be with and without recourse. What's without recourse? If the person you sold the receivables to can't collect them, it's their problem. They take all assets. What is with recourse? If they can't collect them, what do? They come back for us. If we sold them the receivables, right? With recourse. Okay? So what would you rather do? Sell with or without recourse? I'd rather sell without recourse, wouldn't you? But guess what? The fees are higher. And therefore my loss is higher. Right? So because risk, right? They're assuming the risk instead of me. That's it. Right? Okay. So here's secured borrowing. He's got $700,000 in account receivables. The Citizens Bank is collateral for a $500,000 note. Okay, good. They assess 1% up front, and then they want 12% interest too. Okay? So, and they make monthly payments to the bank for all cash it collects on the receivables. Okay, so we're going to still collect them, but it's assigned, right? So we assign them to the bank as collateral. So the bank's not collecting them, we are. So how does this look on both sets of books? So let's take some time and let's run through what happens with these. All right, so how much collateral did we put up? We said 700,000. So we have 700,000 of our receivables tied up. We can't use them as collateral for any other debt. How much did we borrow from? Not really. They only gave us 493. Yeah, but yeah, we got a $500,000 note. That's true. Okay, so I've got a note payable for 500, but they only gave me 700 or 493,000 cash. Why? They took 1% up front. That's additional interest, right? And they call it interest expense. That's good if it's all going to happen within the same accounting period, right? It might be prepaid interest, otherwise you're supposed to. Something like that we would amortize over the life of the note. You can do it that way. I won't do that to you, but you could if it's long term. Okay? So I have a note payable. What does the bank have? Note receivable, right? And interest revenue. Everybody good? Okay. We'll call it interest if it's a loan. We'll call it gain or loss if it's a sale. What do you think? Sound logical? Okay, so it's not hard to remember. I don't know if you can remember it, just know it. Okay, so then we collected $440,000 of accounts receivable, less cash discounts of $6,000. Okay, and then we had $14,000 on sales return. Okay, everybody got it? Let's call it a sales allowance because they didn't make a journal entry for inventory coming back in. If you got a sales return, you'd have to make a journal entry debiting inventory, right? And crediting cost of goods sold with effectively, or crediting sales returns and allowances. Everybody agree? Okay. Putting it back in. So what do we do with this? This is on my books. I'm Howard Mills. Debit cash for the 434 I got. I have sales discounts. I have sales returns and allowances, right? And I have accounts receivable going away, okay? How much am I going to give to the bank? All the cash I collected of 434 plus interest on the debt. But here's the deal. They only gave me 493,000. What are they charging interest on?
700.
Well, not 700, luckily.
500.
Oh, just the 500 they loaned me. Yeah. Okay. So they've hit me for 7,000 on that 500, right? So they really only loaned me 493. And then they're getting me for interest on the whole 500, which is 5,000. Everybody agree? Everybody see what's going on? Okay. So that's 5,000 for 1 month. It was 12% interest, 500,000, 1% a month was 5,000. Everybody got the idea? Well, what interest did I really pay? Oh, well, okay. Debit interest expense for the 5, debit notes payable for the full 434 that I collected. So I gave them the interest in addition, right? And then credit cash for 439. Sound good? They debit cash, credit interest revenue, and credit notes receivable. What was my interest rate for that 1 month, really? It wasn't 1%. What was it? The deal's almost done. I'm only collecting a little bit more in the next month. What was the interest for that 1 month? Let's see, I've given them so far $7,000 plus $5,000. I've given them $12,000, and I borrowed $493 from them. What's 12 divided by 493? This is a quick turnaround on these. These are 30-day receivables probably, right? They're getting collected really fast. What's that interest rate? Yeah, 2.43. Take that times 12. They're charging me 30%, not 12. What would you rather do? Go to the bank and borrow money at 12% and give them your receivables as collateral, or would you rather do this? See what's going on here? And factoring would be even more. Okay? Right? When you sell it. You're on the ropes. That's what you're doing. Okay? All right. So, okay, fine. But of course, everything's negotiable. It could be 0.5% fee up front, right? And lower or higher interest rates, depending on how risky you are, right? Okay? And how good a negotiator you are, I guess, too. All right, anyway, so then they collect the rest. They're collecting $244,000 in the next period, and then they have a write-off for $2,000 on allowance for doubtful accounts. So the rest of the receivables are gone, $246, right? So $454 and $246 is the whole $500,000 of those receivables are gone, huh? Right? Is that what that is? Or that's $700,000, I'm sorry. The whole $700,000 of the receivables are gone that we had assigned to them. Either they've been returned, or we had discounts against them, or we finally wrote them off. Got the idea? This is writing off bad debts of $2,000, right? You don't debit bad debt expense, you debit allowance, don't you? Right? You guys all know this. Okay, so good. So I've got it all there, but what happens? How much do I owe them? If I borrowed $500 from them and I paid them back $434, I only owe them $66,000. So there's the notes payable, the $66 being paid off. And then the interest would only be on the $66,000 at 1%, right? So for that period, it's $660, and I give them that additional cash. Okay? Who keeps the rest of the cash? I collected $244, and I only gave them $66,000. It's mine, right? That's mine. Who took the risk of the bad debts? I did. I didn't sell my receivables. Who gets the sales returns and allowances? I do. I didn't sell my receivables. Yeah, yeah. Okay. So I get the bad debts. I have the discount. Sure. Okay. This is pretty straightforward. Not bad. Okay. Okay. What's the big change that we have here, really? This is fee up front, probably. Huh? Okay. They got it. Another way we could have done it is they could have collected the money, okay, from me, okay. This one has a 2% account, 2% finance charge, interest on loans 10%, a realistic rate on this type of note, okay. So we're assigning $500,000 for $300,000. They want you to run through it. It's the same thing. There's that finance charge up front. This time they only loan them $290 now, the 2% finance charge. Then they've got the cash coming in, and they pay against the note, record the interest too. So it's just the same thing. Okay. So let's try disposition of accounts and notes receivable with and without recourse. On the without recourse, purchaser assumes the risk of collection. Okay? Without recourse. Transfer is an outright sale. Seller records a loss in the sale. With recourse, the big difference is the seller guarantees payment to the purchaser. And we use a financial components approach to record the transfer. Here's the only difference. With recourse, the company that sells the receivables estimates what their liability is for receivables that are never going to be collected, right? It's kind of this, there's a symmetry of information. The person selling the receivables knows how bad they are. The person buying the receivables doesn't know how bad they are. If the person buying the receivables knew some of those folks probably won't pay them, they wouldn't take the receivables. They'd say, no, I don't want those, you keep those, right? So the person selling them knows some of them aren't going to pay. They're going to ask them how much that's not going to be. They record it on their books. For the person buying them, right, factor buying those receivables, they don't know that number, so they don't record it. So all that happens is we set up a reserve on our books. If I'm the one that's selling my receivables, I set up an obligation, right, a liability, and that increases my loss because I'm going to credit the liability creating it because I think I'm going to owe it. All that changes is my loss. So when you run through these, it looks like it's what's going on, but that's all it is. It's just not a big deal. So let's look at some numbers, some examples. Okay, here's how the deal goes. Factors are finance companies or banks that buy receivables from businesses for a fee. Okay, so what happens? The customer wants to buy from the company. The company can't support the receivables themselves, right? They can't finance themselves. And the factor, the bank or whoever it is, doesn't trust them to loan them the money to do it on their own. Okay, got the idea? So they're high risk. So the company requests from the factor permission to sell to that customer. Because really the bank is going to cover that receivable. Got the idea? They're going to be taking the risk if it's without recourse. They're taking a lot of risk anyway, even if it is with recourse, because you have to try to collect from people who don't have money, right? So still that risk. So they get approval of credit, and they advance the cash to cover it, basically, is what happens, okay? So the company produces the goods, ships the goods to the customer, right? The customer makes payment directly to the factory, okay? So they own the receivable. So that's what the process looks like, okay? They're advancing us cash to actually produce it, okay? We ship the goods, the customer's happy, and we still have a profit left, we hope, okay? We still make some money. Our sales price is still high enough that we make some money, even though we give a big chunk of the profit to the factory. That's basically what happens, okay? All right, so how do we account for this? Here's an example. Quest Textiles is producing clothing, I guess, and Commercial Factors is providing us with the financing. So here we are. Without recourse, they're charging us 3% up front, right? And then they're going to retain an amount equal to 5% of the accounts receivable. So they're taking 3% of our receivables, right, as their fee, okay, right up front. And presumably they're going to wait 30 days and they're getting 3% for 30 days. Got the idea? 36% in this case, if that's all they have to wait, okay? But it's not interest, of course, because we sold it. So it's a loss, okay? So how would we do this? What are we going to get? This time I'm giving them all 500,000 of the receivables. What do they charge me? 3%, which is 15,000 in this case, right? Is what? Loss on sale of receivables. It's instead of interest, it's called a loss. Got it? Because they didn't borrow that. Everybody get their head around that? It's just not a big deal. Loss on sale of receivables. Okay? Then what else did they say? They're withholding 5% for probable adjustments. This means if they don't collect, or there are returns, or there are discounts, or there's disputed items, get the idea? You have to write down the receivables for any reason, okay? What happens? We're still on the hook for 5%, okay? So Crest Textiles is still on the hook for 5% of the 500,000 for 25. So how big could their loss be in total? It could end up being 40,000, right? Because you're only getting 460,000 out of the 500. Now here's the deal. If the factor, Commercial Factors, collects this 25, they'll give it to us. If they don't have to give us anything. Got the idea?
So is it kind of like
Sorry,
a
Brian.
replacement for an allowance for doubtful accounts if that's gone?
Kinda, yeah. Yeah, so we're still on the hook for it, right? That are not. But it's not allowed for doubtful accounts because we don't have receivables anymore. Right? Okay? So they call that a due from factor. I have a receivable from these guys for the $25,000. If they collect $485,000, if they collect the $460 they gave me plus this 25, in other words, if they collect everything but 15, right, 485, they have to send me the 25. Does that make sense? Okay? They never have to send me the 15. They collect the 500. Did I say that right? If they collect the whole 500, I'm sorry, I said it wrong. If they collect the whole 500, they have to give me 25 of it. Every dollar they don't receive up to 475, right? Every dollar of that 25,000 from 500 to 475 comes out of me, and my loss just gets bigger and bigger. What about though if they collect less than 475? What do you think then?
They have to assume the loss.
They assume, yeah, they assume, okay? So, they're still on the hook, aren't they, right? They're still in trouble. So they gave me 460 and they're hoping to make 15, right? Okay, they'll give me 25. All right, on their set of books, they now have the receivables, right, the notes receivable, they just bought them. They'll have financing revenue, where I had a loss on the sale, that's how they make their revenues. So financing revenues. It's not really a gain, right? They bought something, you don't have a gain from buying something, but that's how they earn their revenues. They gave me the cash, right? And they have due to match my due from. Everybody good? Okay. These will drive you nuts when you start working these problems, guys. Practice. Okay. All right, before we go on to this, let's answer this. What if, let's say it's that entry, it's right after that. I received cash of 460, right? I have a due from factor, 25. I have a loss on factoring, 15. And I no longer have my account receivable of 500. That was the deal, wasn't it? So there's what I have. This is the company that did the factoring. This is the factor, bank or factoring company, finance company. They credited cash with 500. They would debit accounts receivable, which credited cash for 460. Debit accounts receivable for the 500, debit factoring revenue, credit factoring revenue, credit factoring revenue for the 20, 15, and then due to the company for 25. Here's where they're at. Okay, let's do different scenarios. Okay, let's try different scenarios. Let's say that we collect, okay, who's going to collect the money? Yeah. Factor, okay? So the factor is going to collect the money. So what kind of a journal entry is the company going to make, the textile company in this case, going to make when the factor collects cash? None. Okay? So let's say they collect the whole 500. Debit cash, 500. Credit accounts receivable, 500. Sound good? That's it. They're done. Then what would they do? Yeah, you gotta get, they would pay them their 25,000, wouldn't they? Debit to company, 25. And credit what? Cash, 25. And like I said, they get to keep 475,000 when they only gave them cash for 460. What's the difference? That's their revenue. They just collected the revenue, didn't realize the revenue. They collected it. Very good. What would the company do? Debit what? Cash. It's that easy. change the scenario a little bit. Instead of collecting the entire 500, let's say they collect, so let's have them collect 490. Okay, so this time it's going to be collect cash of 490, and they give up. What would they do? That's all they think they're ever going to get.
Credit accounts receivable, 490. Debit due to co, 15. Credit cash, 15.
I'm only going to send them 15
Because you're only.
because I'm
not
protected to what? What level was I protected to? 475, right? So I still get to keep 475. They get 15. Sound good? 490 less. That's 475. Okay. All right. So you want to do what? Debit what? Rid of what? You want to get rid of what?
Due to.
The entire due to goes away. But I'm only going to give cash at 15. Is that right? I think so. What's the 10? That's the accounts receivable I never collected yet. In fact, I don't need to write them off. It's their problem, right? That would go back to them, right? I got my money. I'm done. I got my amount of money. My 490 less my 15 is my 475 that I had coming, right? 460 cash I gave them plus my 15 revenue. So then what would have to happen on the company? They no longer have a due from. It's gone, isn't it? Everybody agree? So these kind of drive you crazy. Try a few of them. Due from factor goes away by 25. How much cash did they get?
15, and then a loss of 10.
They could have another loss of 10. That would make sense. I kind of like that. Loss on factoring. Because if they gave up, you're probably never going to collect it.
Yeah.
Or it could be accounts receivable. You could try to collect it, I suppose. Right? You got it back. I think it's another loss of 10. Everybody good? But what's my loss limited to? 25. So let's say that the factor this time collects, let's have them collect 450. Debit cash 450. So this one's a disaster, right? They're not happy. What are they going to do? Debit cash, credit accounts receivable. How much? All 450. Then what are they going to do? They're giving up. Debit due to company. Credit what? I guess. Is that enough? If they're going to give up on the rest, how much is the rest? Another 25? What are they going to give up if they give up on the rest? I don't know why that doesn't extend a little bit, but it doesn't. Give up on the other 25, and where are they going to go with that? Loss, or maybe they did an allowance when they bought these receivables. And where would it go? Allowance for doubtful accounts, bad debts, right, effectively, or it could go to loss, right? So they're still exposed for a loss, that's the point, okay? What would these guys do over here? They got to get rid of the due from factor. They don't let you know. You can count on that. Be real upset with you. And debit what for 25? More loss. Okay? So they're only exposed to 25 more, that's the point. So both of them could get hurt here, right? In this case, you only collected 450 out of 500. So yeah, still get loss for share. Everybody good? What would happen if it is instead with recourse? What would change?
The company has to assume the entire loss because the guarantee payment.
It's gonna, yes, comes back to you, the whole thing, right? Okay.
Have to pay the 15.
They'd have the whole 50. They take the whole 50 loss. The fact none of it. But you get back the receivables. Yeah, thanks. Receivables are not collectible, I get back. Right? But that's what happens. Okay? Now the reality of this, will the factor really be able to collect from the company? If it's with recourse, if they're broke anyway. Yeah, it might not make much difference, right? But at least they have the right to go back after. Okay? So here's an example with recourse. What changes? Now take a look at this. It's the same deal, right? The cash received is 460. The due from factor is still 25. It's still, what was that, 5% of the 500, right? Okay? Our original loss would have been how much? The 15 fee they charged me, right guys? Everybody agree? It was 15 fee. It was 3%. So it still is. From the factor's standpoint, that's still their revenue. But we're the textile company. We're the company that's doing that's factoring our receivables out, right? Okay? So what do we know? We know how much of those might be bad. We make an estimate of how much is never coming in. So we have another 6,000. We think we're never going to see 6,000, okay? So really my loss isn't 15. What's my loss really? It's 15 plus my estimate of the 6 they're never going to collect. You guys with me? So they're not going to give me 25. What are they going to give me? 6 less than the 25, they're going to give me 19. So my real loss is what? I get the 460 up front, later they're going to give me 19, my proceeds are going to be 479, and I sold them 500 to receivables, so I lost 21. You just add the recourse liability to the loss. Debit loss, credit, recourse liability. Okay? And this gets us down. Just with what the entries, especially when you start looking at payments. So this is kind of fun stuff. Okay? So prepare the journal entries on both sides. Here we go. Debit cash, debit due from factor, debit loss, okay, and credit accounts receivable. What changed, you guys? I increased the loss, right? Okay, and I increased the recourse liability. You see it? The loss went from 15 to 21 for that recourse liability of 6,000. Their estimate of how much was going to never be collected. Okay, and the recourse liability is 6. Do I still expect to receive this 25? Not really. It's 25 less 6. I expect to receive what? 19 from it. Got it? Okay, that's all. It could be worse, it could be better when it actually pans out. Notice what happens with commercial factors. Does this look familiar to you guys? Oh, crap. They called it interest revenue. Is that interest revenue?
No.
No. What should that have been? That's a
Yeah,
mistake.
that's everything.
No, commercial factors didn't sell. They're a factoring company, and this is how they earn their... Yeah, factor revenue. You got it. This is factoring revenue. That's a mistake. Many times, additions to the books that we do, I'm sympathetic. I tell you guys, I did tell you guys, that paper that I gave you on whack cap them, in the solutions to that paper, maybe I didn't mention it, the input, like I told this. The solution that I have for that isn't the right solution for the problem.
Yeah, it's really a problem.
Well, we changed something someplace, right? In the problem probably, and then the solution didn't match anymore. There's a mistake in it. And I thought, oh my God, how did I get these switched around, you know, the copy I had? That's what got printed in the journal and published it. The wrong answer. I mean, it's the right answer, just the numbers are a little bit off. You know what I mean? It's computed right and everything, the solution, but it's not the right solution for that problem. We changed it. And it went through all these different reviews, me and David and Dan looking at it over and over, and it's still wrong. I put it in the press. So I'm sympathetic. You know, these things happen all the time. So, and I make fun of it. I say, oh, some master's student did this, right? Or some graduate PhD student did it, maybe. But yeah, that'd be factor revenue. Why isn't it interest revenue? They didn't loan any money, right? So it's got to be factor revenue. It can't be interest revenue. Okay, anyway. So, but you'll see it. You'll see it throughout in this chapter. They do it both ways. They really should. They're not loaning money. Okay, anyway. So you see what changes, guys? Only on Crest not on commercial factors. Because commercial factors doesn't know about the recourse liability that you added to your loss receivables. Everybody good? Okay, simple? Okay. Okay, secured borrowing versus sale, we'll come back to this in a second. Let's see. Okay. So what I'd like you to do is change these to be with recourse. Can you do it? Let's change it to with recourse now. What changes here when it goes to with recourse? Driving me totally crazy. What we changed on the first one? For the factor, what changes? Nothing. No change. Okay. No change over here for with recourse.
How much are we assuming?
And what's our liability?
Yeah.
The six, it's the same, let's use the example they gave us. Let's change this journal entry. What does it have to change to? Cash is still 460, due from is still 25. What about loss? That's the 21. And why is that the case? You got it. You guys know what you're doing, don't you? Not bad. So I got a recourse liability, and I think you just have to practice some of these. Recourse liability is how much? 6. So now I have a recourse liability. Everybody good? Nothing changed for the factor, but we have a new recourse liability, and that increased our loss for the company. Okay, it did the factor. All right, so let's say they collected 500. What would happen? Let's use these examples. See how they fall out.
Or wouldn't the cash and due be the same?
Yeah, cash and receivable would be the same. The due to company go away, cash go away. Sounds good. What would happen over here? What would happen to the company? They get the cash, due from factor goes away. Don't stop. Yeah, they got to get rid of their recourse liability. Excellent. Just got to remember to close everything out, right, guys? That recourse liability's got to go away. Debit it for what? 6? Need to credit something for 6. Tell me what to do. Yeah, if it's in the same accounting period, loss on factoring, right? Got it?
If it's not,
Recovery of loss. It's in a subsequent accounting period. Recovery of loss of factoring. Make sense? Or if you're factoring every period, you can just net it out, the loss of that. That makes sense? Reduce your loss. Okay, good. All right. What if it's 490? Let's try that. Factors still going to look the same, aren't they? What's going to happen to the company? They don't have a 10 loss this time, do they? Aren't you still going to get rid of the recourse liability? How much? Still 6, right? Everybody agree? Everything stays the same on the factor, like we said, always does. Okay? I get rid of the recourse liability. Huh? My cash still stays 15 they sent me, right? My due from factor is still gone 25. I thought I was going to collect 19. I only collected 15. How much loss do I have? 4. Reduce it by the 6 that I already recognized as loss. Big deal. Right? Everybody good? Okay. How about it's 450? These guys wouldn't change. Now what do you think?
And loss be 50.
What's going to happen here? Oh, I take it back. These two are going to change. Take it back. They didn't get enough money, did they? What are they entitled to? The first what? $485, right? 485, yeah. They're supposed to get 485, aren't they? Right? They're 15 feet, so they were supposed to collect everything, huh? So what would they do? And what would we do? What would happen to the factory? They receive cash of $450, right? Accounts receivable goes down by $450. Would they have this allowance thing down here going on? Or the loss? No, they're not gonna have a loss, are they? They're gonna have additional loss, assuming they think they're gonna collect it from me. Huh. So how much accounts receivable is gonna come out of here? It's an interesting. This is where it gets really fun. How much accounts receivable are they gonna take away when they give up? Whatever the term says, how they have to do it, right? Before they come back after whatever the agreement says. They're gonna take 50 out of here, aren't they? And they're gonna get rid of the 25 due to me. And I'm gonna get rid of the 25 due from them too. What's this other 25?
The company owns them.
Yeah, due from the company. This looks really funny. So they get rid of the due to the company and put in its place a due from the company. I'm going to get rid of due from the factory, and what am I going to have to put in? Due to the factory. How much is that going to be? Whoops, backwards. Due to the factory's liability, right? So I get rid of the due from, the receivables gone. Recorded due to the factory for 25. Huh. What do I have?
A loss of
50.
Yeah, loss of 50, I guess. Or if you think you're going to collect it at some point, what could you do for a while, I suppose? They're giving me back the 50 of receivables there. Right? So actually what they probably do in the agreement is hold the receivables and have to due from me also, right? Until I pay them. Then they give me the receivables that are left. Okay, they hold it. So yeah, probably lost.
which they expect.
What's that?
Like this,
I
like,
apologize.
factor, determine a period within which they expect to collect the receivables, and then if it goes outside that period, then they.
Yeah, you'll have terms. So the terms might be 30 days, and maybe they give them 60 days to collect it before they come back and issue, or 90 days, or whatever you want. You can anything negotiate. Yes, you set terms. Time. And then, of course, you'd have to, if you were the factory, you'd have to decide they actually have the capacity to pay you. If they don't have the capacity to pay, you might go ahead and recognize a loss anyway for the factory. Right? Bad thing. Okay? Everybody good with this stuff? This could sort of turn your brains inside out. Have some fun with it. Okay. So, conditions that you gotta meet. Let's take a look at this real quick. I'll let you out of here. Okay. The FASB concluded that a sale occurs only if the seller surrenders control of the receivables to the buyer, right? Okay. So, with recent change in the U.S. GAAP, the accounting guidance transfers substantially converged. So what's the transfer? 3 conditions have to be met. Transferred assets isolated from the transferor. They're not my receivables anymore. They belong to the factory. Transferee has the right to pledge or sell assets, right? So people who bought them, they're theirs. They can sell them now. They can pledge for loans. Transfer does not maintain control through a repurchase agreement. You don't have the right to rebuy them. Then if there's continuing involvement, if yes, you reduce your receivables, recognize assets, and obtain liabilities incurred, and recognize the gain or loss, so you still record it. If there's no continuing involvement, reduce your receivables, or you just record the gain or loss, okay? So you don't just reduce, or you don't recognize assets, obtain liabilities incurred, okay? There's no with recourse liability, okay? And if it doesn't meet these conditions, it's just secured borrowing, right? Now you've done effectively an assignment. You'd have interest expense and liability. Okay? Not too bad.
With every purchase agreement, you can buy it back, right? But you can't sell it with an agreement to buy it back? Is that?
Yeah, you can't sell it with an agreement to buy it back. Well, you wouldn't buy them back anyway. If I
I
buy
was
it, I'd
curious,
never
yeah.
buy it back.
Okay.
Right? you need cash. If I could get to the point where I didn't have to sell my receivables, I certainly would. If I could sell them out, then I have enough cash, be profitable enough, I'd get out of this factor. What kind of interest rate is that? 3% up front, for instance, in their example. 3% is 30-day terms, probably. You just get clobbered. How much profit do you have on the deal, probably? 5, 6, and you're giving them 3. See what I mean? So, it depends what your gross profit is like. And what your operating costs are. Okay. So they do some analysis of receivables presentation. Be sure and read through this. Cash controls, read through it. The petty cash system, read through it. That's really easy, but it's worth looking at. And then they do a bank reconciliation problem in here. Just crank through it and make sure you're still good with that, that you feel good about it. These are not too hard. What was down here at the end that you want to look at? Yeah. Oh, impairment of receivables. Okay. You need to evaluate receivables to determine ultimate collectability. Use an allowance method, of course, on the accounts receivable and the notes receivable. But also, when its problem has been impaired, the loss can be reached and estimated. Long-term receivables such as loans are identified as impaired. Companies perform additional impairment evaluation. So take a look at this stuff. Investment loan, generally the principal plus accrued interest, and then get the expected cash flows and discount them, what we've been doing all along. So we constantly look at whether or not there's been a permanent impairment in the value of all of our assets, all of our non-current assets. And so they show you a nice example of this. Expected loss of cash flow, what the discounted present value is now. So here we've got our recorded investment, and we take the present value of the future cash flows. If it's less, what do? Record a loss of impairment. Okay? You do this with property, plant, and equipment later too. We look at its present value of future cash flows it's going to generate and compare it to its historical cost, and we write it down. Okay, guys? So bad debt expense and allowance is the idea here. Okay? So, all right, guys. I'm done here. Thursday.
Wait, how do you do a loss?
I did a lot. Oh, I'm reducing the loss. I recorded too much loss. When I recorded in the first quarter, I recorded 21 loss. And it turned out only 15. Or you could call it, if it's in a subsequent accounting period, you recover the loss. Okay. Stimulating stuff, huh?
After you save that recording, can you go back to slide 77?